start with the big picture. Legal entity type and tax classification are not always the same thing. A corporation is a separate legal entity from its owners. An LLC is also formed under state law, but the IRS can treat it different ways for tax. On the EA exam, they love asking two things: who pays the tax and which return gets filed. A C corporation is the classic separate taxpayer. The corporation files Form 1120 and pays its own income tax. Then, if it distributes after-tax profits as dividends, shareholders may pay tax again on those dividends. That's the double taxation idea. Also, the corporation doesn't deduct dividends, and shareholders can't deduct corporate losses. Here's a number you must know. C corporations are taxed at a flat 21% federal rate. The Tax Cuts and Jobs Act eliminated the old graduated corporate brackets. On exam questions, if they're hinting at corporate rates, they're usually fishing for that flat 21% and the fact that it's the corporation paying it on Form 1120. An S corporation is a corporation under state law, but it elects special tax treatment with the IRS. The key concept is pass-through. Income, losses, deductions, and credits generally flow to shareholders instead of being taxed at the entity level. The S Corp still files a return, Form 1120s, but it's usually an information return that supports what goes on to shareholder returns. One exam trap: S Corp never pay tax. Generally true, but not always. The S corporation itself can owe tax in limited situations, like certain built-in gains and passive investment income issues. You don't need all the details here yet. Just remember the exception exists, so you don't overstate the rule on a tricky multiple-choice question. Now, LLCs. An LLC is formed under state law, but for federal tax, it has default classifications. A single-member LLC is usually a disregarded entity, meaning the IRS ignores the entity and taxes the owner directly. A multi-member LLC is usually taxed as a partnership and files Form 1065. But an LLC can elect corporate treatment, typically by filing Form 8832. A quick note on PLLCs. They're LLCs for state law, usually for licensed professionals like doctors, lawyers, engineers, and CPAs. Not every state allows them, and ownership can be restricted. For EA exam purposes, the big takeaway is that PLLC doesn't automatically change federal tax treatment. You still apply the same default LLC rules and elections. Ethan and Sabrina form a domestic LLC and file Form 8832 to be taxed as a C corporation. Soon after, they switch to be taxed as a partnership. 2 years later, they want to switch back to C corporation status again. How long must they wait before they're allowed to change to a different entity classification? The options include 1 year, 5 years, 90 days, or 3 years. Think about it. The answer is 5 years. After an eligible entity changes its classification election, it generally can't change again for 60 months. 2 years isn't enough. A tempting wrong answer is 3 years, because it sounds like a common waiting period, but the rule tested here is the 60-month limitation tied to Form 8832 elections. Question: all of the following types of entities must be taxed as a corporation, except which one? The choices include a joint stock association, a business owned by a state or local government, an insurance company, and a business with annual gross receipts of $28 million or more. Think about what actually drives entity classification. The correct answer is the business with annual gross receipts of $28 million or more. There's no gross receipts threshold that automatically forces corporate taxation. The other choices are examples that can be treated as corporations based on their nature under the classification rules. The tempting trap is thinking big business equals corporation, but size alone doesn't do it.